Hello, and this is Global Business Insights, where we look deeper at the headlines from a business perspective. As expected, the Bank of Canada delivered a back-to-back 25 basis points interest rate cut, taking its policy rate to 4.5% from 4.75% at its monetary policy meeting today. In the US, June sales of new single-family homes fell 0.6% month over month as high prices and mortgage rates continue to weigh on buyers' ability to buy. It was the lowest reading in 7 months, well below forecasts. And just in today, US preliminary PMIs, Purchasing Managers Index for July, showed S&P Global Manufacturing PMI slumping to 49.5, while Services PMI improved to 56. That was in July. Earlier, we saw the pound sterling favored after preliminary Purchasing Managers Index data also for July showed the composite PMI in higher at 52.7 than estimates of 52.6 and a former release of 52.3. Also in today, Eurozone July Purchasing Managers Index signaled flat business activity as the composite index fell to a 5-month low of 50.1. Reactions continue to come in on yesterday's 296th MPC meeting of the Nigerian Central Bank and the decision to raise interest rates by 50 basis points to 26.75%. And Tesla reported latest quarter earnings, missing analysts' expectations on earnings, profit margins, and free cash flow. Operating margin shrank to the lowest in 3 years, dropping to 14.4% from 18.7% a year earlier. Also, the fourth straight quarter of shrinkage. Another Magnificent Seven player, Alphabet, reported earnings of $1.89 a share, beating estimates and revenue of $84.74 billion, also ahead of $84.19 billion expected. But revenues from YouTube advertising, that used to be a sure cash cow, fell to $8.66 billion, below $8.93 billion expected. The big question many are asking, are mega tech stocks beginning to lose their glitter? And back in Nigeria, Moody has commented that proposed windfall taxes will have a negative effect on banks, significantly reducing profits available for problem loan provisioning and transfers to their retained earnings. Meanwhile, it seems government has dug in as senators proposed the tax be increased from 50% to 70% and possibly extending the relevant period. We'll also replay a chat with special guest Adewale Ajayi, partner and head of tax, regulatory and people services in KPMG, Nigeria. First, on some macroeconomic data out today, in July, US preliminary composite PMI improved to 55 from 54.8 in July, but we did see S&P Global Manufacturing, the PMI, slip into contraction to 49.5 from 51.6 in the same period. The largest sector, that's the services PMI, rose to 56 from 55.3. This survey confirmed what it called a Goldilocks scenario at the start of the third quarter, with a growing economy while inflation moderates, no hard landing in sight in the US. And in the UK, manufacturing and services PMI expanded to 51.8 and 52.4 respectively, better than prior releases. According to Chief Business Economist at S&P Global Market Intelligence, Chris Williamson, it painted a welcoming picture, and also he sees indeed that prices have meanwhile risen at their lowest rate for 3.5 years, further raising the prospect of a much anticipated summer rate cut. Unlike in the UK, for Europe, the reading was weaker than forecasted. We also saw a lingering divergence between a downturn in manufacturing and growth in the larger services sector. The manufacturing index fell deeper into contraction from 45.8 to 45.6, while services fell from 52.8 to 51.9, still expanding. Analysts were not surprised when a data-dependent and very orthodox Nigeria Central Bank MPC hiked rates another 50 basis points. Not good news for manufacturers groaning under the pains of what the governor has described as unavoidable rate actions to achieve a more sustainable path of growth in hopefully the near future. The indications are that the food import duty waiver will taper inflation. And as the refinery begins to produce PMS, that's the Dangote refinery supply, will improve, and we can't discount the impact of the new minimum wage, which will, albeit marginally, result in slightly higher inflation as higher interest rates also increase savings and moderate inflationary pressures. On the FX front, the Naira is expected to recover, boosted by 11 months reserves, import cover, and improving confidence from about 1,700 Naira to the dollar to about 1,500 to the dollar in September. The central bank was, however, mute on its 21.4% inflation target by end 2024, now at best highly unlikely. The next two CPI readings ahead of September MPC meeting will be instructive in determining next moves. Analysts see inflation abating. Hopefully, the data will show that. Are Magnificent Seven stocks beginning to lose their shine? Maybe not so, but we are seeing some cracks in the armor. Tesla is struggling to find a positive spin as they announce dismal results. Tesla shares fell over 10% in early trade today. The electric car sector is seeing tough times, and Musk is changing the topic, now talking up robo-taxis and humanoid robots. He also puts out a poll asking if Tesla should invest $5 billion in his artificial intelligence startup xAI, confidently encouraging investors who don't think Tesla will crack self-driving to sell the stock, which seems to be what they are doing. Looking at Tesla's stock as we speak, down 10.4%. Alphabet stock also struggling, though it did beat on both earnings and revenue. Disappointing YouTube revenues, however, were not missed, and there is some concern about the future as it invests heavily in AI to retain its leadership in the profitable search business. Higher spending on people and technology continues to weigh on the numbers. And for the rest of the Magnificent Seven, many say too much good AI news has already been priced in, and we may continue to see that rotation into smaller cyclical stocks. On the 17th of July 2024, the federal government of Nigeria proposed a new bill to tax FX realized profits of Nigerian banks. Moody has said in their report that this will hurt Nigerian banks, and the proposal was initially for 50% tax on the realized profits from all FX transactions. We understand the Senate are very keen to pass the bill, also raising the tax to 70% and maybe extending the applicable time from the commencement of the new FX regime till 2025 financial year. We replay our chat with our special guest, Adewale Ajayi, partner and head of tax, regulatory and people services in KPMG, Nigeria. He commented on how the proposal can work better to achieve the government's objectives.
Under the proposed bill, the Federal Inland Revenue Service will be responsible for assessing and collecting the tax. Though the banks have the option to settle the tax due in installment, such installment plan must be approved by the FRS on or before 31st of December 2024. Any bank that fails to pay the tax as and when due or implement an approved installment plan with the FRS will be liable to a penalty of 10% per annum, together with interest at the prevailing CBN rates. As controversial as this proposed bill may be, one can truly understand the justification on the part of government seeking to explore every available source of revenue. Given Nigeria's current tax to GDP ratio of 11%, this is just not sufficient to deliver the requisite infrastructure that is required for sustainable growth in Nigeria. In the 2024 budget, the projected deficit is about 9 trillion naira, and I'm sure and I am convinced that this amount must have grown significantly since then, given the current subsidy on petrol. Therefore, the country has been relying on borrowing to finance its projects. We all know that debt is not a sustainable practice compared to taxes. As at 31st of March 2024, the total public debt in Nigeria was $92 billion. And I'm sure that this must also have grown significantly since then. The current debt to GDP ratio is in excess of 50%, which is even higher than the self-imposed limit of 40%. Though I'm not worried so much about the debt to GDP ratio, what I'm concerned about is the ability of government to finance the related interest. As justifiable as this move may be, the question is always whether this is the right timing, given the fact that all the banks in Nigeria are exploring every opportunity to meet the minimum capital requirement stipulated by the Central Bank of Nigeria. However, if the government decides to implement this bill, there are certain modifications that need to be made to the bill. Firstly, is the reference to the Finance Act 2023 as the principal act. The principal act for the purposes of companies' income tax is the Companies Income Tax Act, and this should be the act that should be referenced. So this should be corrected. The second issue has to do with clarity on the 50% rate. The question is this a top-up on the current 30%, or banks are meant to pay additional 20%? This needs to be clarified. And the third issue has to do with the ability of banks to deduct realized exchange losses. As we have realized exchange gains, we also have realized exchange losses. So the question is, can the banks deduct their realized exchange losses from the realized exchange gain? And the fourth point has to do with the need to cushion the impact of the tax on the banking industry. In most jurisdictions where windfall tax has been implemented, there is always some relief that is provided to the affected taxpayers. I proposed an investment allowance, maybe a one-off, or for a period of 3 years, of at least 10% on future investment made by banks in technology and software. This will help to enhance the efficiency of banks. And most importantly, I think it is very important for the government to conduct an impact analysis on the effectiveness of the tax to deliver the fiscal objectives and the impact on the banking industry.
And Germany's largest lender, Deutsche Bank, saw shares fall as it reported its first quarterly loss in 4 years. Looking at markets, European markets were lower as investors digested the latest earnings from the regional banks and US tech companies. On Wall Street, US stocks also down after mega cap tech companies Alphabet and Tesla reported lackluster second quarter results. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Again, thank you so very much for watching. Bye-bye.